September 2008, a bank with more than 150 years simply vanished overnight. Around $600 billion gone. Retirement savings evaporated. Millions lost their jobs. But what if I told you that the real spark started with a slogan simple enough to fit on a billboard? Why rent when you can own? Cue upbeat music. It is 2002. America is still recovering from the dot-com crash. The shock of 9/11s has Wall Street nervous. But the Federal Reserve is not. They have a plan. Slash interest rates to almost zero. Boom! Money gets cheap. Borrowing becomes effortless. And suddenly the national hobby is no longer baseball, it is buying houses. Congratulations, you are approved for $500,000. But we make $40,000 a year. Do not worry. Adjustable rate. Balloon payment. Ninja loan. Ninja loan? No income, no job, no assets, and still approved. Back then, home ownership was not just shelter, it was the American dream. Status, stability, a backyard, and a picket fence. And every advertisement shouted the same message: why rent when you can own? Banks loved it. They shoveled money at people, like a game show where every contestant won. That is how subprime loans took over. Mortgages for people with shaky credit, unstable income, or a very flexible relationship with debt. Missed payments, spotty job history? Living in a trailer? Congratulations! You qualify for a luxury condo. But what if I default? Relax. If you fail, we sell the house for more. It was a modern gold rush. Buyers flooded the market, prices skyrocketed, and a neighbor's house could double in price within months. Baristas making minimum wage and fast food workers with tiny savings were walking out with mortgages. And traditional rules thrown straight out the window. Risk assessments? Too boring. Down payments? Optional. If you had a pulse, you had a mortgage. People collected properties like instant noodles. Brokers made commissions faster than they could say bubble. Behind the shiny surface was blind faith that real estate always went up, because it always had, until it did not. But beneath those granite countertops, one question lingered. What could possibly go wrong? Spoiler, everything! But that was just the warm-up. By 2005, buying a home was no longer about living in it. It was about flipping it for profit. Real estate became a lottery ticket. I teach kids during the day and buy condos at night. I just bought my third property with zero down. I do not live in any of them. Sorry your latte took a minute. My bank just offered me another penthouse. This was not investing, it was obsession. Buy, flip, profit, repeat. More buyers meant higher prices, and higher prices brought more buyers. It was like trying to extinguish a fire with gasoline and everyone had a lighter. But inside the boom was rot. Subprime mortgages, those loans everyone gorged on, were terrible. High risk, low documentation, barely verified. But Wall Street had a magic trick. Bundle the junk and sell it as treasure. Enter mortgage-backed securities, now with 80% more marketing glitter. How do you turn toxic loans into safe assets? Simple. You convince ratings agencies to call them AAA. This bundle includes bankrupt baristas and unemployed personal trainers. Looks fine. AAA. The part they skipped on the brochure. The ratings agencies were paid by the banks they judged. Like hiring a food critic and paying them only if they call your raw chicken gourmet. But Wall Street was not done. They chopped those bundles and remixed them into something even more confusing. CDOs, collateralized debt obligations, financial alchemy, garbage dressed up as premium assets. Yet not everyone was fooled. A handful of odd investors read the fine print. They saw the mold inside the boom. And instead of joining, they asked the forbidden question. What if we bet against it? Problem? No financial product allowed that. So they walked into marble offices and said, these loans are trash. We want a profit if they collapse. Make something. You want to bet against housing? Adorable. Fine. You want insurance? We will sell it. You pay premiums. When nothing happens, we collect. Easy. It is not like the whole system will implode, right? Wall Street smelled easy fees. They doubted the collapse but loved collecting steady premiums, and so credit default swaps were born. Insurance contracts that paid out if those mortgage-linked assets failed. The bizarre twist? You did not need to own the asset to insure it. It was like buying life insurance on your neighbor's grandma and rooting for her to trip on the stairs. The whole financial world became a Jenga tower of leverage. Every block a risky loan, every layer a bigger bet. At the top, champagne and bonuses. Ethics left the building, whistleblowers got ignored, regulators dozed off, decision makers were too rich to care and too greedy to stop. The music played on while the floor cracked. The collapse, when the music stopped, at first it was whispers. One mispayment here, one foreclosure there, one empty condo in Las Vegas. Then came the wave. Suddenly headlines screamed, "Home prices are falling. Real estate always goes up." It is basic. Not this time. For years, the market was a Jenga tower of optimism. In 2007, someone pulled the wrong block. Subprime loans began imploding. Mortgage-backed securities went nuclear. Banks discovered their safe assets were financial plutonium. AAA packages? Radioactive. We cannot sell this. The market is gone. So that means, yes, we are finished. Panic spread. Hedge funds bled billions. Banks took enormous hits. And then, boom. Lehman Brothers, 158 years old, collapsed. No rescue, no safety net. Just a $600 billion crater. If Lehman could die, anyone could. Within hours, banks stopped lending to each other. Credit froze. It was like someone unplugged the global economy. I need a loan to make payroll. No liquidity. What does that mean? It means we are closed. Everything jammed. Families could not get mortgages. Businesses could not pay workers. Investors could not cash out. Retirees watched their pensions vaporize. 401 toasted. Life savings gone. The job market vanished. By late 2008, it was full collapse. Millions unemployed. Foreclosures piled up. Eviction notices stacked in mailboxes. Soup kitchens overflowed. Unemployment offices resembled disaster zones. It was not only Wall Street burning, it was Main Street free-falling. And the shock traveled across borders. Iceland's banks collapsed. Tokyo stocks plunged. Europe scrambled. From London to Reykjavik, Tokyo to Sao Paulo, markets crashed and banks buckled. A new question emerged. Is the entire system broken? The Great Recession had begun. The rescue, billions, fury, and bitter taste. The U.S. government faced two choices: let the system burn or pour billions into the same institutions that lit the fuse. October 2008, they chose the second. I need $700 billion. For what? To throw into burning banks before the world explodes? Enter TARP, the Troubled Asset Relief Program. In practice, it meant buying toxic assets and bailing out banks. They were not merely too big to fail, they were big enough to drag everyone down. So the money cannon fired. Loans, capital injections, stock purchases, whatever kept the system breathing. If your balance sheet was smoking, the government brought the hose. And bailouts were not just for banks. AIG, the insurance giant that bet trillions on toxic swaps, received over $180 billion. GM and Chrysler got around $80 billion. It looked like economic emergency medicine on a scale unseen since the Great Depression. Meanwhile, at the Federal Reserve, the rules of modern finance were rewritten. Interest rates cut to near zero, borrowing basically free. Then came quantitative easing, printing money to buy bonds and mortgage sludge. Imagine patching a sinking ship with $100 bills. And strangely, it worked, at least for markets. Confidence returned. Banks unclenched. The stock market bottomed in March 2009 and began crawling upward. Wall Street exhaled. Main Street, however, was still choking. The damage was brutal. Unemployment hitting 10%, around 8 million jobs gone. 4 million homes foreclosed, and roughly $19 trillion in household wealth erased. Families who never missed payments suddenly owed more on their homes than the homes were worth. And public anger ignited. Wall Street bonuses are back? I just got evicted and they get rewarded? The ones who caused the meltdown were rescued. The ones who lived through it were abandoned. While executives popped champagne, ordinary people stood in line for food assistance. Then came the backlash. In 2011, in Zuccotti Park in New York City, crowds assembled with tents, signs, drums. One sign read, "We are the 99%. The outrage was not only about bailouts, it was about a system built to shield the powerful, profits privatized, losses socialized. Almost no accountability, no major CEO in handcuffs, no perp walks. Instead, golden parachutes and serene retirements. The financial machine survived, but public trust incinerated. A generation learned that when banks gamble and lose, they get saved. When regular people stumble, they get crushed. Because if 2008 taught anything, it is that the next crisis never looks like the last one. It looks safe, profitable, and inevitable. Until the day it does not. Years later, people still analyze that era like investigators studying a wreck. They make charts, teach lectures, film documentaries, and write books, trying to explain how an entire financial culture convinced itself that danger did not exist. Some say it was greed, others say it was ignorance. Others blame incentives, politics, or belief in endless growth. The truth was likely a blend of cheap credit, distorted risk, and collective optimism that drowned out caution. Documentaries, movies, hearings, and papers appeared, creating new terms for the public: systemic risk, moral hazard, contagion. For many, these sounded like distant jargon, yet the impact was deeply local. It lived in neighborhoods full of for sale signs, in dark windows of vacant homes, in families who packed boxes and left without knowing what came next. Some people rebuilt slowly. Some never recovered. Some changed careers or moved away. Some stopped trusting banks entirely. Others became interested in the machinery of modern finance, how credit flows, how speculation grows, how confidence and fear steer the economy. In classrooms worldwide, teachers present the crisis as a modern warning. They compare it with the Great Depression and urge students to notice when markets seem unstoppable, because that is often when collapse begins quietly. The legacy of 2008 is not only written in bailouts and bankruptcies, it lives in new rules and skepticism, in debates about capitalism and risk. And it lingers as a reminder that a financial crisis is never just numbers on a screen. It is about people, homes, and futures, and about how fragile even the biggest systems can be when everyone assumes they are unbreakable. The echoes of that shock still shape policy and public debate, reminding everyone that prosperity is not guaranteed and stability must be protected ever. And that's how the world discovered that even massive institutions with decades of prestige can crumble when greed, leverage, and blind confidence collide. The most surprising part? The story doesn't really end in 2008. The aftershocks shaped how governments regulate banks, how investors think about risk, and how ordinary people view mortgages, debt, and retirement. A whole generation grew up with the idea that financial systems are powerful, but also fragile. In the end, one core lesson remained. When everyone believes something is too big to fail, that's often the moment the cracks start forming beneath the surface. Now I'm curious about you. What part of this whole saga shocked you the most? And more importantly, do you think a collapse like this could happen again in our lifetime? Share your thoughts, theories, and take-ins in the comments. Also, drop topics you'd love to see as videos: economic disasters, political turning points, tech conspiracies, corporate scandals, historical events, you name it. If it's wild and real, we'll turn it into a cinematic story. And of course, subscribe to the channel, hit the notifications, and buckle up. We've got a lot more stories to tell.